Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing language of business and finance. We're digging into a company's recent moves today, and let's just say things are getting a little more expensive for some people, but potentially cheaper for the company itself, a classic financial juggling act before we dive in if you enjoy getting the real story behind corporate filings. Without all the jargon, make sure you hit that subscribe button and the notification bell so you never miss an episode. We also have a fantastic Discord community linked in the description below where we discuss these reports and more so come join the conversation. Today we're looking at a company that sounds like it is building something important, new Mountain Private Credit Fund SPV ILLC, which is a mouthful, so we'll just call them NewCred SPV for short. They've made some significant amendments to a credit agreement, which is basically a big loan contract we need to see what that means for the company and for anyone involved with it. So what is the big deal here? NewCred SPV is a subsidiary of New Mountain Private Credit Fund, and they've entered into what they call the Second Amendment to their First Amended and Restated Credit Agreement. This might sound like a lot of fancy legal talk, but it boils down to them changing the terms of a major loan that is already in place. The key players here include NewCred SPV. As the borrower, the company as the equity holder. Elder and manager, and a bunch of lenders, agents, and administrators, including big names like Goldman Sachs Bank USA and Western Alliance Trust Company NA. The most interesting changes in this Second Amendment impact the timeline and the cost of borrowing first. They're extending the reinvestment period date. This period is when the company can use the borrowed money to make new investments. They've pushed this by a whole year from December 2027 to December 2028. Think of it like a window for making new deals. They just opened that window. Wider meaning they have more time to deploy their capital. This could signal a strategy of continued growth and investment. They're also pushing back the facility maturity date. This is the date when the entire loan has to be paid back. They've extended this by a year as well, from December 2029 to December 2030. This means they've got more breathing room to manage their debt obligations, a pretty significant extension that suggests they might need that extra time or simply want to de-risk their short-term financial planning. Now, for the cost of that money, the company has managed to reduce the spread. They're cutting it from S plus 2.20% to S plus 1.75%. This is a direct reduction in the interest rate they'll be paying on this loan on the part that is tied to the benchmark rate. S represents the benchmark rate. For example, if S was 5%, the old rate would have been 7.20%, but the new rate will be 6.75%. This is a good thing for the company as it means lower interest expenses, which directly boost their profitability. It shows they've improved their standing or negotiated a better deal with their lenders, probably due to their performance or market conditions. The company is registered in Maryland with a file number of 000-56694 and an IRS employer identification number of 99 to 6,860,731. They also appear to be an emerging growth company, which gives them some flexibility in how they report their financial information. These changes are considered material, meaning they are important enough to inform investors about, and that is why they're filing this report under Item 1.01, which covers the entry into a material definitive agreement. They specifically mentioned that the full Second Amendment document will be filed as an exhibit to their annual report on Form 10-K for the fiscal year ending the 31st of December 2025. This amendment also ties into Item 2.03 of their filing, which deals with the creation of a direct financial obligation, or an obligation under an off-balance sheet arrangement. Essentially, amending a credit agreement is a direct financial obligation. This just reiterates the significance of the loan changes. And finally, as is standard practice, they've listed their exhibits, including the interactive data file that makes these reports easier for computers to read and analyze. So what does this all add up to? Well, on the surface, New Mountain Private Credit Fund, SPV ILLC, has successfully renegotiated a significant loan agreement to their advantage. They have more time to invest their funds, and they've managed to lower the cost of borrowing, which is a double win. This suggests a company that is either performing well and has leverage with its lenders, or is strategically positioning itself for future growth by securing more favorable terms. This extension of the maturity date and reinvestment period indicates a long-term outlook. Perhaps they are anticipating continued favorable investment opportunities, or they are building a more robust structure to weather potential economic uncertainties. The reduction in the spread is a clear financial positive, directly improving their bottom line by reducing interest payments. This careful management of debt and investment timelines is a hallmark of disciplined financial strategy. However, we always need to look beyond the press release. While this looks good, it is important to remember that extending loan terms can also indicate a need for more time to generate returns or a strategy of deleveraging over a longer horizon. Without seeing the actual financial statements, which are not detailed in this particular filing, we can only infer the company's health based on these debt agreement changes. The fact that they are an emerging growth company also means they have some regular or leeway which can be beneficial, but also means we might not get the same level of immediate detailed financial disclosure as a more established company, the external context. Here is crucial for a company like this. We'd want to know more about the broader private credit market conditions and how New Mountain's strategies align with or diverge from industry trend. In conclusion, New Mountain Private Credit Fund SPV ILLC has made smart moves to optimize its debt structure, providing itself with more flexibility and lower costs. This is generally a positive sign of proactive financial management. But as always, we need to see the underlying financial performance to get the full picture. What are your thoughts on these loan amendments? Are they a sign of strength or a need for more time? Let us know in the comments below if you found this breakdown useful. Please smash that like button and subscribe for more corporate insights. Don't forget to join our Discord community in the description to keep the conversation going. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.